So if we ever took silver to a real value where it was in 2011, when it was at $50 briefly, or 1980, and factored in the degradation in the money, silver would probably be $200 just to match its real value then. Okay. So I don't think there's any resistance right now between here and 50, and I don't think 50 is resistance. It's a phantom set of highs that are so old and so long ago that if anybody wants to try to sell against the $50 highs, I bet it doesn't work. And if it works for 2 days, it won't work any longer than that. I think we're going to blow that stuff out.
The golden period for silver may be just beginning. Prices have surged to their highest level in over 13 years, rising by 22% over the past year. Although silver recently encountered resistance at $39 an ounce, it retains strong momentum, with analysts watching closely to see if it can challenge the 2011 all-time highs. MichaelOliver of Momentum Structural Analysis puts those past price peaks into perspective. He notes that the so-called $50 highs from 1980 and 2011 were brief, unsustainable spikes. When adjusted for the erosion in the dollar's real purchasing power, silver would need to climb above $200 to match those historical peaks in real terms. From a technical standpoint, many see the current rally as a major breakout, with silver once again drawing serious attention from both institutional and retail investors. If silver crosses the $40 mark, the next significant technical target is $41.77, the high recorded in August 2011. Oliver argues that there's no substantial resistance between current levels and $50, and that even the $50 threshold is unlikely to serve as real resistance this time. According to him, shorting silver at that level would likely prove costly, as a breakout could trigger a sharp upward move, leaving many investors behind. In the first half of 2025, demand for silver was driven by rising geopolitical and economic uncertainty, as well as bullish price forecasts. Optimism around renewed trade talks between China and the United States also lifted sentiment in the industrial metals sector, providing added support for silver prices. Investor interest continues to grow. Silver-backed exchange-traded products reached $40 billion for the first time, already surpassing the total for 2024, according to the Silver Institute. Oliver also points out that silver and silver miners are now outperforming gold on a relative basis. The spread between silver and gold has broken out, suggesting silver is no longer lagging. It's waking up and positioning itself to lead the next leg of the bull market. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. Your support is greatly appreciated.
I think we're in an acceleration phase now in silver. In other words, the bull trend has been going on since the lows in 2015 for gold miners, and silver. Silver and the miners have been somewhat irregular participants in that ongoing monetary metal bull trend. But I'm going to suggest to your viewers that they punch up a chart on their quote screen. Just not momentum, what we look at, which usually tells us ahead of time. So look at a simple, stupid weekly price chart and go back 10 years, and draw a line across, go back to 2022 anyway. Remember 2022, that's when silver had a plunge and gold had a plunge. Gold dropped from over 2,000 and dropped down to the low 1600s. It's a 20% correction, actually, for the only one it had in the whole bull trend. And silver had a nasty pullback. It got down into the $17 level, I think. Plot that weekly price chart, and when you punch it up, draw a line across the highs of the last several years, so 22, 23, 24, and into this year. And you'll find you can connect a whole bunch of peak weekly price closes. And there's an uptrending line across those highs, meaning it defines the ascent of silver. And it's hit that line 1, 2, 3, 4, 5 times over the last several years, where it hits that line of ascent and bumps its head. And then you get a pullback. Nevertheless, it continues up. That line of ascent pretty much defines what's going on in silver. It's going up every year. Okay. Yeah, there are pullbacks, there's pauses, et cetera, et cetera. Well, our momentum work in early June, so 5 weeks ago, let's say, told us, we're going to accelerate now. In other words, we're not going to follow some prior line of ascent that everybody's used to. Price just joined in last week. And if you plot that line, you'll see that last week's action punched through it. In other words, if that line was a ceiling, an ascending ceiling of resistance, even price now says, I'm out of here. Okay. You blew through it definitively. And, and pullback this week isn't even threatening that. In other words, we've accelerated the market. And I think what's about to happen over the next 5 or so months is likely to be the kind of strength that people aren't used to. And therefore, they'll probably doubt it, all the way up, like, oh, this can't be. I think we're headed into a period of ascent for silver that is far more demonstrable, far stronger than gold on a percent gain basis. Same is true with the gold and the silver miners. They have now, when we measure their spread relation to gold, or we measure silver's spread relation to gold, we're getting breakouts saying, hey, we were sleepy for a while. Now we're going to beat you, Mama Gold. And I think you should put your seatbelt on because I think the next 5 months or so will be quite interesting. People doubt that because they're so accustomed to what they've been taught by silver itself. Its behavior pattern it's been embedded in investors' minds. Well, this happens to many markets, whether they're in a bear trend or a bull trend. They may suddenly at some point in the trend say, hey, enough of this. I'm going to move more quickly, whether up or down, in this case up. And I think we're going to be probably in the $60 to $70 zone in the next 5 months or so. Okay. Now, and that's not the end of it. I don't think we're going to end the bull market in gold and silver like we have in prior peaks, like in 1980 or 2011. I don't think that's what's coming. I think what's coming is so many institutions, assumptions, and markets will be turned asunder that we're going to end up with monetary metals being money yet again. And I think it's going to pop up here, this country, that country. And already in the United States, there have been several states that have not just not taxed gold and silver transactions, but have made them legal tender. Florida has done it. Texas has just done it, where they're in effect telling the central bank of the government, you don't have monopoly control over money anymore. We just legalize gold and silver as legal tender. You can pay your taxes with it. So in other words, they're in effect seceding from the national monopoly control over the money unit, which is of course an unbacked piece of paper. They're replacing it with, that kind of process is underway in its infancy, and it's going to grow more rapidly, especially as we see an economic downturn, which I think we're going to see, and the stock market trap people. I think it's been topping actually for a couple of years, where it'll make a gain, have a sharp pullback, and make another gain, but it isn't sustained, and another drop, et cetera. I think there's distribution going on, and I think the market is topping. And when it tops and goes down, that's when you see the data points go awry, to the point where the central bank pulls their hair out and the central government does the same, and they have to go to monetary excess, which we know our current president is all in favor of. He's told them, get rates down to 1%, whatever. That is going to further pave the upside for the monetary metals. And even those, quote, $50 highs, if you go back and look at them, like on a weekly chart or something, they're almost phantom highs, meaning you're up there so briefly, it's like you were hardly even there. It was just thin air and it collapsed. Okay. And those old highs, when you, of course, value silver at that time, let's say 1980 at $50 or 2011, 14 years ago. What's happened to the dollar since then? I don't mean the dollar index, but the real buying power of the money unit. It's continued to collapse. So if we ever took silver to a real value where it was in 2011, when it was at $50 briefly, or 1980, and factored in the degradation in the money unit, silver would probably be $200 just to match its real value then. Okay. I don't think there's any resistance right now between here and 50, and I don't think 50 is resistance. It's a phantom set of highs that are so old and so long ago that if anybody wants to try to sell against the $50 highs, I bet it doesn't work. And if it works for 2 days, it won't work, any longer than that. I think we're going to blow that stuff out and get it far enough beyond it to where people have to then sit down and say, golly, I missed it. And right now, from everything I read, and I don't pay a lot of attention to this stuff, but the average investor's portfolio in gold, et cetera, is so trivial in the US particularly that it's laughing. I saw a Bank of America statement of positions of people in various asset categories, and gold was like off the page. It was like less than 1%. They still don't believe it, and yet it's been beating the stock market.
MichaelOliver notes that historically, when gold reaches a significant peak, its momentum structure typically breaks down within a couple of months. That hasn't happened this time. According to Oliver, we remain well above any key breakdown point, suggesting the move may not be over, and possibly not even close to ending. Gold prices held their positive tone through the early European session on Tuesday, trading just below a 3-week high set the previous day. Some repositioning ahead of the upcoming U.S. consumer inflation data has pulled the dollar back from its recent peak, which in turn has helped gold regain some of its strength. The gold market has been choppy, with prices fluctuating within a broad consolidation zone. This has made short-term moves more unpredictable and tested traders' patience. However, longer-term indicators remain constructive. Oliver cautions against overreacting to every short-term sell signal. He emphasizes that, structurally, looking at long-term momentum compared to multi-year averages, there's still no sign of the market being overbought. In his view, there's no clear evidence of a top forming. Instead, he believes gold remains in a position of strength, with potential for another leg higher once the current consolidation resolves. Let's get back to the interview.
It's been virtuous because what it's allowed to happen is while gold has gone sideways since April, so we're now 4 months of this, going nowhere. It's not a top. Gold never tops going sideways. Go back and look at the 2011 peak. Go look at the 2015 low. It doesn't top going to sleep. When you see gold go into a range, it's a launch pad for another move. But during the last 4 months, since gold peaked in April, May, June, July, it hasn't gone down, it's gone this way. Every time the bears think, oh boy, it's on its way, goes right back up again. That's a launch pad. But during that time, what's happened? Silver and the miners have gone vertical, meaning the spread relationship between the silver and gold and the miners in gold has firmed sharply. Why? Not because gold's gone down and they've gone down less, but they've actually gone up while gold held its own. So the spread is firmed, favoring the miners and silver. And I think it's lovely what's been happening, because the quietness in gold again has put people to sleep thinking, well, there's nothing going on here. Yeah, it is. Take a look at a SIL chart, silver miners. Go back 5, 6, 7 years. Look at a GDX chart. Go back that same amount, just price chart even. Price is now saying what momentum has already told us is going to happen. We're going back. I think GDX and SIL, for example, those two mining ETFs, the 2011 highs will be blown out with ease in the next 5 months and exceeded dramatically. And I think it's underway. Yeah, it's going to be more vertical, though, than what they're used to for the last 10 years in gold, which has been a layered process. I think it's going to be far more vertical, which is going to surprise them. And yeah, there will be pullbacks, but they'll be sharp and over with quickly, and they won't be as deep as some of the other pullbacks we've seen. That's what I think is about to unfold. His question again was,
where are your sell points
sell points. Oh
specifically?
yeah, I about chuckled, pardon me. When we look at long-term momentum, such things as a 3-year average oscillator, where we oscillate the price of gold versus its 3-year average or versus its 3-quarter average, long-term yardsticks. We're not even near any numbers that would say, oh, it's over. On short-term basis, you could always get sell signals here and there, but they're like, You get out at every sell signal, you're unlikely to get back in time. In other words, yeah, it's a trader's thing. You might drop for 2, 3 weeks, but if you don't get back in 2 days later, it's back at the highs. You know what I mean? We've seen this repeatedly. We're not near any long-term momentum structural breakage points. Now, when we go back and look at peaks and troughs and go major lows and major highs in gold through history, going back to 50 years that it's been legalized, when it makes a high and turns down, it breaks structure very, very soon after making the high. Example, MSA turned major bearish on gold in January of 2012. It was only 3 months after the high. Okay. And when you made your high in September, October 2012, 11, and you dropped some, didn't do anything on a price chart, but for annual momentum of gold, it said, uh-oh, you just broke the backbone going back quite a few years on the momentum chart. So we turned major bearish, and we had to put up with a lot of complaints because most of the public wasn't willing to go bearish then. And we said, no, be gone. Well, sure enough, gold labored. After it made its high at 1920, it dropped down into the high 1500s at some point, and then lived between that level and the upper 1700s for the next year. Kept trying to go back to its high, but couldn't. So it wasn't sideways action. It was sideways action after a peak. But it had broken already 3 months off the high its annual momentum trend. Same in 2015 when it made its low in December of 2015 at a price of 1,050. 2.5 months after that low, actually a month and a half after that low, in mid-February 2016, MSA went long-term bullish again because we had broken annual momentum trend structure to the upside. Right now, we're not even near any breakage levels. And when gold makes a high or a low, what happens is the momentum structures move up to where they're very nearby the action so that when it breaks even modestly, it's got something to break of significance. We don't have that now. I'm not fearful of a top in gold. Now, silver, if you look at where it is in relation to the S&P, we ran charts on it a couple weeks ago. It's beating the pants off the S&P, but nobody's aware of that. Anyway, that's going to shift. And when the public finally realizes that, ooh, I missed it, or ooh, it's been doing well, and ooh, the stock market's not doing so well, because I think these new highs in the stock market are a bear trap, a bull trap, in which people think a new price high means something. Not always. Sometimes it's a teaser and a top. This is exactly, by the way, the price behavior of the stock market back in 2000. We got bearish in January, and the son of a gun went sideways for a whole year. In fact, made new highs after we said, be out of this market. They were marginal new highs. Well, in 2007, same story. It was laborious tops spanning much of that year. And we put out a sell signal, for example, on the S&P in January of this year, well before it really started down and showed downside starting in March, really. It's when you started to see the pain. And then April, of course, it puked. We're only marginally above those highs. So it's behaving just like it was at those two prior major tops. Laborious, teasing new highs that really don't go anywhere. And then finally, it just implodes. And by the way, there's one, if you want to look for a signpost, 2001, January 2001, you weren't very far off of what had been the high monthly close in the S&P in August of 2000. The Fed cut rates twice after a long period of pause. 2007, September, October, the Fed cut rates after a long period of pause. You could have put a signpost, a tombstone on the market when they cut rates and circled it, said when they cut rates, short it. We got CPI and wholesale prices coming up this week and also jobless claims. So it could be interesting because if any of those data points give the Fed an excuse to finally say, okay, we're going to cut rates, and we know there's already a bunch of Fed governors wanting to cut already, in fact, insisting we do it in July. All you need is about one or two more to say the same thing, and Powell's going to have to finally give in. I'm waiting for a rate cut. That would be the tombstone on the stock market. Anyway, I think events are starting to really get to a crescendo point here. Dollar index, which had been asleep for 2023 and 2024 in an 8% range, now suddenly has started downside fairly sharply. T-bond market, which is normally an alternative to the stock market, and a co-upside driver with gold as the stock market tops 2000, 2002, 2007 to 9. If you own T-bonds, you did pretty well. T-bonds are acting bad. And of course, that's very unnerving to the central bank and the central government. There's only one market that's behaving quite well.
Breakouts aren't always loud, but this one is starting to roar. Silver's recent price action has pierced through long-standing ceilings, not just numerically, but psychologically. What was once seen as a lagging metal is now stepping forward as a pace setter, shaking off its underdog status. With institutional capital flowing in, technical barriers fading, and macro uncertainties acting as fuel, silver is no longer riding gold's coattails. It's carving its trail. As gold holds steady, silver is racing ahead, reminding markets that leadership can change hands when momentum and fundamentals align. Could this be the cycle where silver finally outshines gold and redefines its role in the global financial hierarchy? Share your perspective in the comments section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.